Everybody, and thank you so much for joining me today. My name is Rob Field, and I'm also known as the FI Educator Online. And I'm going to be joined today by Scott Trench, who is the CEO of Bigger Pockets and author of the book Set for Life. And he's going to be joining us today to talk about getting started in real estate investing. And we're going to break down what that looks like, what that means. We really want to try and answer some of your questions today because this is typically an area that, unless you have a teacher who is very into real estate investing and maybe they do it themselves, it's not something that most of us have a lot of knowledge about. I do not personally invest in real estate where I own physical properties. I do invest in another way that we'll bring up in a few moments. But that's why I want to bring in a guest like Scott, who can talk to us about how he invests and then other ways that maybe you could start thinking about investing in your future. Scott, how are you doing today?
I'm doing great. Thanks so much for inviting me and happy to be here.
Thank you so much for being here today. Scott is also the host of a podcast of his own called Bigger Pockets Money, or co-host, I should say. And I had the pleasure of being on that podcast once, and it is a great resource if you want to learn more about money and you love listening. So definitely a great podcast recommendation right there. But today is about real estate. And before we kick it off, you should have a student reflection document that comes with this talk. So it looks something like this. You may have a digital or on paper. The first question asks you before we start talking, what do you know about real estate investing already? So try and throw down what you think you know already. And then if we challenge some of those beliefs later, maybe ask questions about it. If you learn new things, it's going to probably point that out to you a little bit faster as well. And then if you have any questions for us during this talk, your teacher should be able to input those questions via the Q&A feature of the Zoom webinar. If you're watching the replay, please leave your questions in the comment section of the YouTube video, and we will try and get in and answer those whenever we can. Scott, you ready?
Let's do it.
Okay. So I want to start off with the obvious one of why should we invest in real estate? Because many of the guests I've had before are kind of like, keep it simple, big index fund of all the companies in the US. So just stocks, US companies, maybe throw some international in there. You'll be fine. Don't worry about it. It's good enough. Why should we be talking about other investments like real estate?
Yeah, so in my stock portfolio, I agree completely with what you just said. And my stock portfolio literally consists of one index fund for 99.5 or 99.9% of it, and the single share of Berkshire Hathaway B stock in case I ever want to attend their annual conference. So that's my portfolio in the security space. Real estate offers an opportunity to earn a spread between the returns there. So you can earn a better return using leverage intelligently in the real estate investing space than you can in the stock market with additional risk and a whole lot of extra work. So, for example, I might assume that on a duplex that I purchase, I can earn a 15 to 17% IRR over the next couple of years using a 20% down payment and a loan to purchase the rest of it, which is better than what I can get in the stock market. So only if I'm willing to chase that incremental return, a few, 100 basis points of an incremental return over a period of years at the expense of a lot of time and energy, should I really be interested in real estate? And I was willing to do that. And I have reaped that spread over the last, 10 years that I've been an investor. And I expect to be able to continue to do it on average.
Okay. And if you are watching and you've heard a couple of those words like spread, what was the one you said? Basis points, IOR. If you're listening to those, you're like, I have no clue what he just said. Don't worry. There is, like with many different parts of personal finance, there is a lingo or a vocabulary that goes with it that you learn through experience and through learning more about it. So Scott, yeah, I will challenge you to try and break it down for us as simply as you can as we go forward, because we are high school audience who maybe have no experience in real estate investing. And I don't have much either. So I will probably ask you for clarification on a lot of those things too.
Basically, if you think you can earn an 8 to 10% in the stock market, you can earn a 15 to 17% or even maybe a little bit more if you're investing in real estate that you own and operate. That's the difference, the spread. I was using too much jargon to refer to there. I apologize.
But that's it. You're investing in something different than stocks in the hope of getting a return on your money. And that's what investing is at its core. You are putting money in the hopes that it will grow over time or very quickly and return more money back to you, or a higher value investment, something like that. You are looking for your money to grow, and you ideally want it to outpace inflation or what you can get in a savings account or some of these other investment opportunities that we have. Okay, I do want to share one graphic with everyone before we start, because it's something that I always come back to, and I'm like, I love seeing this. this is what different asset classes have looked like over time. And what we'll notice is that there's a bunch of different ones here. Let's scroll down so you can see what they are. We have large cap stocks, which are the biggest companies out there. We have medium, we have small cap. Cap refers to the market cap, how valuable the company is. We have international stocks, so things outside of the US. We have emerging markets, so countries that are just starting to really develop themselves and they're growing quite aggressively. We have REITs, which is real estate investment trusts, and used to kind of represent how the real estate market is doing. And then we have two different bonds. So high grade, which are typically your lower risk ones, and then high yield, which have a little bit more risk to them, and then cash. So how would your investment have done? And for each year, we can see what the top performing asset was all the way down to the bottom performing one. So it goes from high to low. And what you'll notice is that it's not always the same thing. So 08, 09, we had high grade bonds, emerging markets, then real estate really sat at the top for quite a bit. Small cap companies, so the small up and coming companies grew quite aggressively then. And it's just been kind of a mixed bag throughout time. So it's not always stocks. Stocks are not always the winner. It's not always real estate either. But if you have a mixture of all of these things going on in your portfolio, you're giving yourself a great chance of being ahead in any given year and just supporting your portfolio through the ups and downs of the different types of markets. All right, let me get back to you, Scott. What did you think of that? Is that something you agree with?
Well, you can't disagree with the data. That's the data, right? So that's the actual returns. Where I would say there's more nuance is that that's the return of REITs. What has been the return of small income producing rental properties like single family rentals, duplexes, the type of properties that students listening could purchase a year or two or three after graduation, or a year or two or three after college graduation? That one's a lot harder to quantify. And I don't know of an index that's able to do that in terms of returns investors are getting. There are some good things like the Case-Shiller index, which talks about the actual value of home prices and how those have trended over the years. And that's at a 3.5% annual appreciation rate over a long period of time. So it'd fall in the middle of the pack towards the bottom of that, just from appreciation, not counting cash flows on those properties.
And that's a big one. Every real estate deal, when you are starting to buy like your own individual properties, is going to act very differently to what the general market is doing, because every deal is different. And trying to, like you said, quantify all of those would be a very huge research project if it was going to happen. Mm-hmm. Which brings me to my next question. How do we make money from real estate? What are different ways that we can invest and hope to get money back from real estate? So how does real estate pay out?
Yeah, so real estate makes money in a couple of different ways. First is appreciation. The property may increase in value over the time that you hold it. The second is you usually purchase real estate with a loan. So as you amortize that loan, as you pay down the loan, that is adding to your return, especially if a tenant is paying that mortgage for you, then they are paying down the loan for you with the rent. The third is cash flow. So the spread, the difference between the rent and all the expenses, including the mortgage payment, including any repairs and maintenance, any costs you might have for a property manager to manage the property, those types of things. The difference between rent and those expenses is your cash flow, and that's profit that you're able to keep over time. And this is all being done in the context of of tax advantages with real estate that go kind of into a next level understanding. But you're essentially able to depreciate a property that you own, and that allows you to claim a loss on your taxes and makes real estate income and wealth very tax advantaged. You're going to pay much less tax per dollar of income in real estate than you will in a lot of other, for example, working a job or earning business income.
Yeah, and this is a really cool conversation about incomes and income types, and it's a conversation I would love to have with someone in the future. But there's different types of income. The income you make from your job is probably the least tax advantaged income you can have. Money comes in, it gets taxed by the government, by your state, and you get what's left over. When you have income from something like real estate, you have the opportunity to basically say, like, I actually didn't make that much. There was costs and losses that happened along the way, and you only pay taxes on essentially the profit. If you thought of it like a business, it's like the profit kind of thing on your income. So it means that you can kind of say, like, yeah, I made less. Versus if you're talking about your own personal income and you fix your own house, you don't get to really say, like, oh, I made this much. I get to subtract all my expenses, and this is my profit as my income. It doesn't work that way. So it is a nice tax advantage along the way. So definitely think about that one. I hadn't thought about that beforehand. All right. So we got appreciation of property. We've got the cash flow or the rent that it generates. We could flip property. So, they go up, we sell them for more later. We can fix them up. There's all sorts of stuff. Why did you
Mhm.
get involved in real estate?
I got involved in real estate because I wanted to retire early. I wanted to have the option to leave wage paying work as early as possible. And it was less about for me the cash flow and building a real estate portfolio at first as it was about living for free. So the way I got started is I bought a duplex here in Denver and I did some very simple math. This is a $240,000 duplex. My mortgage will be $1,550 per month, including principal, interest, taxes, and insurance. Um, if I put down $12,000, which for me was a manageable amount of money at the time, that was about a year of savings. Okay, that's my mortgage. If I rent out the other side, I'll get $1,150, so 1150, and I'll also get 550 from a roommate on my side. Each side was two bed, one bath. That's $1,700 on a mortgage of 1,550. Yes, there are utilities, repairs, other stuff that you have to do to manage and keep a property, but that essentially allowed me to live for free. And so that was the really compelling, very simple math for why I got started in real estate is I just didn't want to have to pay rent or a mortgage payment at first. And that also translated to when I moved out, I'd be getting an additional $550 or $1,100 from the side that I had vacated, leaving me with a cash flowing profitable property that's producing $500-600 a month in income. That, of course, has grown over the years, but it was as simple as that for me at first. And over the years, it's been okay. I'm going to replicate that. Additional house hacks is the term that we use there. It's how to hack your housing and get paid to live for free, was the idea. So I've bought up additional house hacks, and then I've also just continued because I got comfortable with real estate investing and the frameworks that you need to use to be successful in it. I've just bought a handful of additional properties over the years on top of that to continue to produce cash flow and those other benefits of appreciation and loan amortization that I discussed earlier.
Okay, so like purely just like I want to reduce my costs. I want to live somewhere for free, and this is a way
Mhm.
to do it. It's like you bring the ball to the game. Like you're the one who's like, I will buy the house. I will then find the people to live in it, and those people living in it are going to cover the cost of the mortgage for this property. And like you said, there may be other costs that don't necessarily get covered, but you essentially are eliminating typically the biggest line item expense in the average American's budget. Most people will spend the most on food, transportation, housing, and housing is usually the number one. The recommendation is to keep that amount about 30% or less of your take home pay. So, like, if you're doing the 30%, you're immediately saying, like, okay, I've got an extra 30% of my money that I'm not spending on housing that I can now use in many different ways. And the most exciting one is when you start investing that and making that money grow even more. But wow, that's amazing. It's huge. And is that something that teens can start thinking about doing today? Is it still replicable today?
That's right. Yeah. So the game is how much can you bring in income and how much can you keep, right? And if you play that, if you win that game, if you're able to spend very little and earn a upper middle class income, you can get rich investing in stocks. You can get rich investing in real estate. You can buy businesses. You can do a lot of different things with that capital. That's it. That's the 80/20 of this. It's just a matter of degree within in terms of how much return you can earn on that invested capital, and it will just speed or slow the path to wealth by a few basis, but again, a few percentage points, if you're able to use an asset class like real estate instead of stocks or in addition to. So I agree. That is the 80/20. That is the most important part of this is keep your expenses as low as possible, especially in the years out of high school and out of college, and earn as much as possible and invest that in something, whether it's stocks or real estate. I 100% agree. And the way you do that is by controlling, like you said, the big three expenses: housing, transportation, and food. When I got started, I house hacked. I did what I just told you with that duplex to allow me to live for free. I biked most of the time to work and to other areas that were close by, not when it was raining. Sometimes when it was raining, but that was usually by accident. And I packed my lunch most of the time, right? Like this is literally the key to building wealth is just controlling those three big expenses, and you have plenty to spend on fun, transport, fun and entertainment and all that kind of stuff. If you're able to control those three big ones.
And you all, as high school students, you have the opportunity that most adults don't have, where you get to kind of set your course with a blank slate. Um, most adults, when we start finding the financial world, like for me, I was in my mid-20s, there was already a lot of wheels that had been put in motion. I already had a car payment. I had already made a decision on college and career and student loans and all this other stuff. So it was difficult to be like, oh, well, now I'm going to house hack from the beginning, keep my costs low, do that for a couple of years with roommates and that sort of stuff. And then I will have this pot of money to be able to do really fun stuff with later. You as high school students, you get to kind of set that course if you want to do that. If this is something that interests you, if you're listening, you're like, huh, this sounds really exciting. Like I can live with roommates. Like I was planning on doing it anyway. I can keep my costs low and I can consciously spend that money that I'm saving in a way that's going to grow for the future. Or I can just have a really great time and just keep my costs low, whatever you want to do. But this is a personal finance course, guys. You want to think about like, how can I bring this retirement date closer? How can I make my life wealthier in the future so I can do all the fun things I really want to do?
Yeah.
You said something that I do want you to touch on. It's not necessarily real estate specific, but you said the 80-20. And it's one of my favorite topics, ideas, but no one I've had on yet has talked about it. Do you mind just quickly explaining what you meant by the 80-20 of it?
Yes, the 80-20 is the Pareto principle. It says that 80% of your outputs in of your progress towards a goal, for example, is going to be derived from 20% of the work. So, for example, we just talked about spending, right? If you're trying to cut back on spending and you're an average American and 3/4 of your spend is in housing, transportation, and food, right? And 1/3 is in entertainment, clothes, shopping, or whatever. Well, most people are going to, not most people, many I'll call so-called financial experts are going to tell you, oh, just cut your latte budget for your coffee or cut your clothing budget or whatever. Well, that's dealing with the 20%, the small slice of your spending. But if you actually want to save a ton of money each month, you need to cut out your rent or your housing payment as much as you can. You need to get around for a very low cost by making a very smart car purchase decision. You need to control your food budget very tightly. If you do those three things, you can control 60 to 70, 65 to 70% of your spending in three key buckets. The 20% of the activity that will drive 80% of the actual output that you want of saving. And this is true in most areas of life, right? You want to train for a sport. There are certain, like for example, football, right? You want to like squats, bench press, deadlifts, and hang cleans perhaps are the 80-20 of the workouts you would do to train for football. You should do other things. There's lots of other work that you need to do in order to maximize yourself as an athlete. But if you just do those things, that's probably going to be close to 80% of the key compound movements you need to do to get strength for that particular sport. So that's what the concept implies. And it's always good to dial back in. Am I doing the 80-20 of this? At least am I doing the most important stuff first before going on to the less important stuff later?
Yeah. 20% of the things you do will get 80% of your results. And that's what you really want to figure out is what are the big action items I can take that are going to get me the majority of the results I want. And this is a principle actually that you will see come up in lots of different areas of your life. Scott mentioned working out or sports is one. Business is another one that if you have maybe like 5 products, one of them will do exceptionally well and will account for maybe 80% of your revenue and the other 4 will be kind of meh. Stocks can be the same, that if you have a portfolio of 10, 2 might be the big winners and the rest are kind of meh. It's a very interesting one to see play out in your life. But again, looking for those big action items that will get you the majority of your results that you want rather than focusing on the small little things that won't really move the needle that much. All right. If we want to think about, you probably recommend people all the time, like, hey, real estate investing, this is a really good idea. This is something that can really help you build wealth. What's the pushback you normally get from people? Like what stops them from starting typically?
Yeah. Well, first, there needs to be a goal that we're backing into, right? So, when I talk to someone who's coming out of high school or college, and they're like, "What should I do with my money?" or whatever. Well, it's an impossible question. It's like the Alice in Wonderland quote where the Cheshire Cat's asking, Alice asked the cat, "Which way should I go?" Well, where do you want to get to? I don't know. Well, then it doesn't matter which path you take, right? You have to have a goal. So I always invent a goal, right? I think 3 to 5 years out of high school or college, if you're able to get a 65, $70,000 job, which is, a good job, but that should be a good goal coming out of college, potentially for many students. How do you get to a position of $250,000 to $300,000 in wealth 5 years after graduation? that's flexible, that allows you to have some passive cash flow, that allows you to have some kind of liquidity, right? Imagine a position of 300 grand with 50,000 in cash, $100,000 in stocks, $100,000 in real estate equity producing $1,000 a month in cash flow, and $50,000 in your retirement accounts, right? First, you have to believe that that's a better financial position. Oh, yeah, that's freeing. I could go and take a year off and travel the world. I could go start a business. I could go make a major investment. So if you like that position, now I can back into what you should be doing to get there. If you don't like that position, or if you haven't figured out that position, then you have all sorts of problems with real estate investing as an asset class. To directly answer your question, right? Well, it's risky. I heard my Uncle Joe lost his shirt in the 2008 crash, right? Doesn't real estate come with managing tenants, and you have to answer phone calls at 2 o'clock in the morning when the toilet's clogged from one of your tenants? What about fixing up the place? I don't know how to fix up the place. I don't have time to do it or the skill set to be able to do that. So those would be some of the objections that I think people would have, and those are very legitimate. So I think that you have to be very careful about who you are when you get into real estate investing, and recognize that a couple of things have to be true. First, to get started in real estate, you not only need to have cash, like the down payment, tens of thousands of dollars saved up, or the path to getting there in the next year or two, or the a year or two prior to the decision to starting after the decision to start investing in real estate. But you also have to commit several hundred hours, in my opinion, of self-education. Read 5, 10, 15 books on the subject, listen to podcasts, watch videos, meet local investor-friendly agents, meet investors in your area, really accumulate a body of knowledge to understand what works and how to get comfortable with it. Then, after you've bought that property, you need to spend even more time potentially either fixing it up or managing contractors and project managing them to make sure the property is in good condition, finding and placing tenants, or hiring property managers to do that for you. And for most of the students on this call, they're likely going to be starting at the low end of the income bracket. That's just natural from a career progression standpoint. And they're going to need to do a lot of this work themselves, because that'll be much more cost effective for them than hiring it out. So that's a daunting thing. And that's why most people don't get into real estate investing, is because I think that's the price you have to pay, both in terms of dollars and time, to get into this market. If you're willing to invest for 10, 20, 30, 40, 50 years over the course of your career, you'll make that back in spades, to the tune of hundreds of thousands or millions of dollars in incremental wealth by doing this. But you've got to be willing to put that effort in up front, reap the rewards for a career or lifetime, and do it. And many people, especially perhaps some of the parents of students on this call, will already have careers that are firmly in place, already have investing strategies, and it probably isn't worth it for many of them to go through to pay the price that I just outlined to get started in real estate investing, because they already earn too much money where they can earn a pretty decent return passively in index funds like the large cap stocks that you showed were great performers in the chart earlier.
And that's a really cool point, that when you make decisions like this about your life and maybe going down different business paths or doing things yourself, DIYing things, the question you could sometimes ask yourself is this worth the time and effort and skill and whatever is going to go into it for me to do it myself, or should I pay someone else to do it? And usually the question is, well, what could I earn in that space of time versus what I would pay somebody else to do it? If you can earn more and pay someone else to do it, then maybe that makes more sense. If you will save more money by doing it yourself, then it makes sense to teach yourself how to do this. So early in your careers it's a much easier equation for us. You're probably going to benefit from learning a lot of these skills yourself, learning about how to buy properties, manage properties. So the myths you threw out are there's risk, and it's an investment at its core. Literally every investment you can think of, if it's going to grow your money, has got some level of risk involved. If there wasn't,
and I wouldn't even say it's a myth. That's just a fact, right? Yeah. That's just a part of real estate. Yeah.
And like other investments, you want to try and manage your risk. You want to put yourself in a position where you are making the best decision you possibly can. You are learning as much as you can to reduce the amount of guesswork and risk that you are taking. So just like someone who maybe plays poker, you would say, this is a game of not just chance and not just skill. There's an element of both in there. And you can learn as much as you want to about real estate to reduce the amount of risk that you are taking. But yeah, there is always the chance that a pandemic hits when you're least expecting it. And the
Mhm.
government comes out and basically says, look, tenants can stay for free. If they don't pay the rent, you can't evict them. And you as the landlord are kind of like in a stuck position. Like it happens. But we'll come back to that in a moment, like ways to protect yourself in those situations. But there will be unexpected events that you will not know about. That will also happen in all the other asset classes too. Stocks were terrible over the past year. Like if you were just investing in stocks, you would have seen your portfolio drop close to 10% over the past year. And that's not fun either. Real estate prices typically over time go up, but they can dip in short terms. Even like now, when we see interest rates very high and other factors that would normally suggest that prices should come down in houses, they're not. The demand is still super high and the supply is really low, which is part of what keeps pricing steady or going up. So there's going to be a variety of things going in here, and if you know and understand your risks, you can make a good decision about whether to do that or not. What about the tenant side of things? Because that's definitely one. Like my wife would come out and say, like, look, I like the idea of real estate investing. I don't like the idea of being a landlord.
Well, so when I started, managing tenants is a part of the deal, right? So either you can do it yourself or you can hire it out. When I started investing, I was making $50,000 a year, so $25 an hour. And managing the tenants was a great use of my time because it was definitely more, I was definitely earning more than $100 an hour managing the tenants myself per my estimation, right? Especially when I lived in the property and was right next door to them, very easy to deal with those types of issues. Um, as my income and net worth has grown over the past 10 years, my time is much more valuable than it was at first. And so now I hired out to a property management service. So property management typically costs about 10% of rents. So on that example I used earlier of my duplex, let's say it was still at this $2,200 a month in rent, that I would be paying $220 to the property management firm each month. When I moved out, my cash flow on that property was probably $600-700. So that's like a third of my cash flow, a third of my profit is now going to the property manager. And that's very consistent with the portfolio. That's worth it to me. It may or may not be worth it to another investor. And so that's the decision you'll have to make is managing tenants is not fun. It's work. Am I willing to get paid for that work? And what's my time worth to me? That's why real estate's so powerful again for especially young people getting started in their career, because that arbitrage is real. For a few extra hours of work a month, you could bring in 100, perhaps much more per hour than what you're making at your job. That will change with a successful career over the decades, but at least in the first year, in your 20s, you may find that a very powerful wealth building opportunity to do a lot of that work yourself.
Yeah, and income from real estate is another source of income. We've talked about this before in different guest speaking engagements. If you've been here to watch those, that most millionaires will have multiple streams of income. If you are relying on one single stream of income, such as your job, it's a very high risk move in itself because that job could disappear very quickly, depending on the industry you're in, of course. As a teacher, I feel like I'm in a very secure industry where we rarely see teachers just get laid off, even when recessionary times happen or things like that. But it does happen. Schools get smaller or populations go down. But if you work in the corporate world, you may have a higher risk of losing your job. And things like having real estate income to fall back on just kind of pad that fall if your job disappears. You're not going down to $0 of income. You're going down to, maybe in Scott's case, like 500, that cash flow that was coming in from this apartment. And now you can start trying to rebuild from there or stay afloat or get your core needs met. And the more sources of income you can add in, the less risk each one poses to your finances, because there's all these other ones to fall back on if one of them dries up or has a dry spell or a tough spell, whatever it is. It's a great idea to have diversified streams of income. Okay. The next one I have for you, Scott, is if I'm a teenager, so I'm sitting in a high school class right now, legally, I cannot enter into a contract yet to buy my own place, right?
Mm-hmm.
So what can I do now that either can get me involved in real estate investing right now, or what are some steps I can take to prepare myself for this in the future once I am old enough to enter into a house buying contract?
I mean, the two they're very basic, but I think it's the stuff that I told you about, the price to enter into real estate, the hundreds of hours of self-education. You can start paying that price right now by meeting with real estate professionals, reading books, listening to podcasts and self-educating on real estate and how to solve the problems we just talked about, right? Not just how to, hey, should I manage the tenant or not, but how to manage the tenant, right? What is the application process? What is it? What do those look like? Um, you can get a job and save up money either in the real estate field or somewhere else. The more cash you have, the better you're going to be prepared. If you can work for an investor friendly agent, for example, in the local area or a contractor and develop skills that are relevant to either finding and sourcing deals or doing the work to repair, improve properties or remodel them, that's a skill that will be very valuable and that you can begin working on immediately. You don't need to be 18 to do some of those jobs. So those would be two areas that I would encourage folks to explore if they're younger. But yeah, I mean the actual buying and selling of properties requires down payments in tens of thousands of dollars in order to cover the down payment, expected repairs, closing costs, and a cash reserve buffer. And it will require a significant self-education and skill set, which you can begin acquiring. So you can work on both of those today.
And I was expecting two of the three of these, and the third one, I'm like, man, this is very awesome. Something we need to come back to. But first, you build your credit score. We can start doing that from a young age because you will potentially have to borrow to pay for these houses. Start saving some cash. You will need cash, so start saving it up. There are ways to, I guess, buy a house with zero cash down, but we'll go into those another time. There are ways to do it, but I wouldn't recommend it right away. And then getting educated. Go on.
Yeah, here's one. When in high school, and I didn't even think about this until just now, but I actually worked for a real estate investor in the summers. It was my friend's dad. He owned a large real estate company, and I had to do all sorts of wacky jobs at this thing. I had to go and paint at remodel places. One place there was a hoarder house that he bought, and I had to remove. I actually had to hire some of my buddies to remove the junk from the property, and this was the grossest, most horrible work of all time. I'm really selling this, of course, at this point. But and I was like so embarrassed that I hired my friends to do this, even though they were like happy to get a job for that weekend or whatever, and to repair that. I once got handed a big bag of keys, 200 keys, and it was told to go to a development 30, 40 miles away and figure out which key went to which door and label it in that. Like, I would have all of these types of crazy jobs that now I remember. I'm like, oh yeah, I need to label all of the keys for my rental property portfolio because I don't want to be doing that gig again or sending some hapless teenager to go do that while they're working that job. I had to pressure wash decks, install storm doors, all that kind of stuff. And that was really great work that gave me kind of a basic toolkit to handle problems. I remember I also had to, hopefully this is not a job that anyone here will get, but I had to collect the rent from some of the tenants that paid in cash. And I just remember being so nervous driving around with like $10,000 or $15,000 of cash as this like teenager. And then I hand it to my boss and he sticks it into his fanny pack, all of his cash. So I just had a wild experience with this job, but that kind of job, I think that was a perfect primer for a future real estate investing career. And it was one of 10 jobs that I had in high school and college, between waiting tables and other stuff for one summer. So something like that might be very, very powerful if you can find an investor that needs an intern to go handle odd jobs and just fix up some systems in their business, or similarly at a real estate agent brokerage.
And that was the one I really want to come back to, because how many of you watching are intentional about the work that you do, in the sense of, yeah, I need money, but I chose a job that was going to either increase my skills, increase my knowledge, or build my network for something that I'm thinking about in the future. And I think that's just a huge moment right there, that we have summer coming up, or you've got a new school year starting whenever you're watching this. Are you doing a job that is getting you closer to your goals, and not just your financial ones? Can you sign up for work that will teach you something that you're like, oh, this is a really valuable skill? Like, can you go work on building sites this summer and pick up lots of different skills? Like, you may not be a qualified electrician, carpenter, plumber, whatever it is, but if you can fix a lot of these minor things yourself, it's great for your own house. I know, as in my primary residence, I do a lot of the small minor fixes myself that just save, a couple $100 here and there for hiring a professional to come out. B, if you do end up owning your own properties and you want to be able to do these things, again, saving yourselves lots of money. And then learning the system. Like, if you're working for a realtor, you will learn how the house buying process works, how deals happen, where to look for them. If you work for someone who does real estate investing, you will see it, how the mindset of someone like this works. It could be the do's or the do nots that you learn. That's fine. You can pick up both. You want to learn about lending, maybe see if you can get an internship in a bank. If you want to learn about, people skills and negotiating, like, again, find somebody who works in sales and work with them. Like, and this doesn't have to apply to real estate. Think about any career that you want to have and apply the same logic. Go work in fields that will further your experience, your knowledge, and your skills. No, it's a great one.
That's right.
Thanks so
Yeah.
much for sharing that, Scott.
The summer after that, I worked at Pier One Imports, right? And that was fine. But I didn't use the employee. I didn't want anything from Pier One Imports, as a 18-year-old or 17-year-old college kid or high school kid. So like that was so much more valuable working for this firm as an intern than retail or waiting tables or whatever. Although everyone should probably get a taste of those things as well. But I think that's right. Go try to find work that's relevant in some capacity to investing or working for a business owner that's doing something interesting and learning a lot of odds and ends, even if some of those mean you'll have hard days and some of those mean you'll have really good learning days.
And if you can't get paid work, volunteer work is totally fine. You can also just reach out to somebody who's doing this and be like, hey, I'm really interested in real estate investing in the future. Would you mind like letting me take you out to coffee and just talking to me about your experience? What you did that you recommend replicating, maybe your learning lessons as well. Like that's a very powerful conversation as well, to just say to someone, look, I value your experience and your information. Can I like take them out to coffee? It'll cost you a couple of dollars. That's a huge investment in knowledge and experience, and probably someone in your network who will be in your corner for the rest of your life if you do something like that. And it doesn't have to be a job. It can be free stuff. You can volunteer. You can say like, hey, can I come work on your building site for a day? Give me some jobs to do. I want to learn, and see what they say. All right, so I want to move into the Q&A section of this. And if you are watching and you have questions, just let your teacher know. They can type them into the Q&A section at the bottom of the screen. We would love to tackle your questions. I do have a couple from my students. The first one comes from Taylor, and she just wants to know, like, how do I get started without a lot of money? Do you have any thoughts on that? Like, so is there a way to get started in real estate investing without a ton of cash?
So the answer is yes, there are ways to get started without a lot of money. And there are some proponents of investing in real estate with no cash out of hand. I personally have the opinion that those are much better suited to experienced investors. So when you already, ironically, once you already have a large portfolio, that's the time to use a no money down strategy or creative financing or these types of things. It is possible. But I would encourage you to go to ask the other question. How do I accumulate and grind out the work for the next few years so that I have $25,000, $30,000, $35,000 to put down and use to get into real estate? I'm much more traditional in this view. I think it's much lower risk. I think that getting a good job with a good income stream that you can borrow against for a mortgage and having the down payment in cash to manage these repairs and the hustle to save on those costs by doing a lot of the work yourself is a much higher probability way, if less sexy, than the no money down strategies to get into real estate investing.
I'll add one more in there to that. If, say, you don't have a ton of money, but you're like, I want to include real estate in my investing portfolio. We mentioned REITs before. This is real estate investment trusts. It kind of acts like a stock. It's basically a company has bought a ton of properties and they're selling you shares of that. So you get to experience the ups and downs of those properties without actually having to own them and manage tenants and all that stuff. That can be a great way to just sort of get involved in real estate with very little money. I mean, you can buy these things for partial shares up to a couple $100 in. There's also companies like Fundrise. What do you know about those? That I think like with $500, you can start kind of going in with other people and buying properties.
So would you mind pulling up that chart again for REITs?
Absolutely. There's our REITs.
Awesome. Where's REITs? Go down to the. Can you go down to the bottom of it? Where do REITs stack up against the rest of the asset classes? So large caps right there were 8%. So REITs are towards the bottom of the returns.
Mid-table, yeah.
Middle to bottom over the kind of on the average. They're worse than stocks essentially over a long period of time, right? And I think that's going to continue for the next 50 years. Like if you were to zoom out and say over the next 50 years, what are the averages going to look like? I think they're going to look very much like what you show in this chart. So I think that stocks are better than REITs. I own 0% of my portfolio personally is in REITs or other types of similar products like that. I do invest in some syndication specific deals with operators that I know, but most of my real estate portfolio is in properties that I own and manage here in Denver, Colorado, that I believe will appreciate over time, produce cash flow that I can go to and drive past and work on myself if I wanted to, because I think that's a better return. Not to say that REITs are bad. It's just that if you have a very long time horizon, the math and historical averages will prove out that stocks are going to be, on average, a better return over a long period. And that's, past returns are not indicative of future performance, but that's what I personally believe. And that's why I've designed my portfolio the way I have. But yes, you could certainly buy a REIT or an index fund of REITs or try one of these crowdfunding portals with a small amount of money if you wanted some passive exposure to real estate. I just think for me, it's a better bet if I'm going to go in the totally passive route to invest in index funds.
Yeah, and if you're going totally passive, it's kind of like what Scott said. You've no full control over how this asset's going to perform. And if it's your own property, you can walk in, you can change it, you can manage it. I don't know. I feel like I would enjoy having more control of my destiny and my own investments than I would like being in a crowd-funded platform where there's these properties across the US that I hope somebody's making good decisions on them and, getting good tenants and all this stuff. And I'm just kind of like a passenger for this ride. If I'm going to do that, stocks are probably where I want to be anyway. Next question comes from Mr. Hart's class. And one of the students wants to know, do you consider yourself to be financially independent right now?
Yes. So I'll walk through my portfolio. I have a portfolio of index fund investments. I have a portfolio of real estate properties. I have 13 properties here in Denver. I have an interest in the business that I run at Bigger Pockets. I have written 2 books, which continue to sell and produce income, and I invest in multiple syndication offerings. These are specific real estate deals. Actually, both of those are in Phoenix, so we'll see how those end up over the next few years. But yeah, that produces significantly more passive cash flow or cash flow from the investment portfolio than I need to so that I spend on my lifestyle currently. I'm also very cheap and drive my paid off Toyota Corolla, even though I could buy a much nicer car. I live in a half duplex here in Denver that I own, and the mortgage on that is $3,200, and the other side pays rent for $2,700. So that's allows me to live close to free there. It's a much nicer place than the first duplex I told you about earlier, and that allows me to cover my expenses. I still work harder than ever because I'm the CEO of a company that I'm very passionate about now, and at some point we'll probably start living a little bit more extravagantly, but not until my passive portfolio can comfortably cover the incremental and more extravagant spending that I continue to layer into my life.
That's very cool. So yeah, you're one of the people we've met who are financially independent right now, but still continuing to do things that you are passionate about. And that's the fun part, everybody. It's not retirement in the sense that you immediately push stop on work and you go lay on a beach for the rest of your life and you never work again. It's that power to be like, yeah, you know what? I do still want to do these things that I'm really excited about. If it makes money, great. If it doesn't, that's also great because I don't need it. And the more that you are bringing in, the more extravagant lifestyle you can have, or you can start doing really cool things with that money, like donating it, using it in creative ways, funding your community and building up your environment outside of your immediate one. Money allows you a lot of opportunities and exciting things to do that maybe you can't do when you don't have as much of it. All right, follow-up question from them. What do you invest in when it comes to your, I think, stock investing? So which indexes are you using?
Sure. So my specific one is large cap index. Is a large cap index fund per your chart. I completely agree with the data in there, and essentially 100% of my passive portfolio is in VOO, which is an S&P 500 index fund provided by Vanguard with very low fees. That's a personal choice. It's not investing advice. And I actually think I do have a small amount with another brokerage where I invest in a very comparable one that might be a total market index fund. I think it's through Fidelity, but the Vanguard equivalent would be a ticker called VTI. or VTSAX, which is the mutual fund version of that. That's a lot more jargon than you need. I invest in S&P 500 index fund and then a total market index fund with a small percentage in my retirement account, which I forgot about. 100% of my after taxes. All right, I'll stop now. That was a very complex answer.
That was good.
Yeah.
I like it.
Yeah.
It's a good brush of where you can invest and different companies you can invest with. These broad index funds, there are lots of them available through different companies, but you mentioned too, like Vanguard or Fidelity, Schwab, T. Rowe Price, like they're all kind of the same thing. They're a representation of the entire market and you own a slice of it. They all kind of perform roughly the same and have around the same expense ratio. You can't go too wrong with those, at least as far as past performance would say.
Yeah. I have a favorite one, but not all the companies I'm with offer that particular
Gotcha.
fund. So yeah.
Hunter asked a question and he wants to know, how do you find a good property? And I know you could spend an entire like call just talking about this one question, but do you have any kind of like tips for how do we find properties that are going to do kind of like what your duplex did? It's going to cost you a price that when you have a mortgage, you will be able to comfortably cover that with the income that comes from tenants, roommates, that sort of thing.
Yeah. So I'll give you a 3-minute answer there, and then you can come off with this. So first, you need to build a buy box, right? 2 paragraphs, right? 2 paragraphs that specifically outline what you're looking for. I'm looking for a duplex, triplex, or quadplex here in Denver, Colorado. Over time and by meeting with investors, I identified 5 neighborhoods that are particularly attractive to me because they're in the path of progress with new government investments, or they're near new private investments that are coming in, like new shopping centers, those kinds of things. If they're on this edge of that market, I'm willing to pay more because it's close to the park or whatever it is. On this edge, it's a little farther away, and I need to pay a lower price point or better cash flow in order to make that work. I like 1950s builds because I'm used to dealing with those, and I own other properties that have built around that same time. So I know the problems that come up with those types of structures. I'm looking for 175,000, give or take, per unit. And I love 2-bed, 1-bath, or 1-bed, 1-bath properties because they're easy to rent year round. Whereas if you have a 5-bed, 3-bath property, much larger property, then that might be attractive to a family, but they're only going to move in July or August, which makes it just a little bit harder to keep it occupied at full rent over the course of the year. So that was very specific. And to get to that point takes some time, several months or a year of getting to know the market and networking and self-educating, right? But once you have that, now we can look at the market and we can say, what has actually sold in the last 90 to 100, 180 days in this area? And what is it sold for? And I can say, okay, that's great. I'm looking at the market. Those are actual comps, comparable properties to the things I could buy today that have actually transacted in the recent past. Now I know what a good deal looks like, right? That's a definition of a good deal. If I would have bought, let's say, 5 properties in the last 90 days or 10 properties in the last 180 days that were good deals to me, now I know that in the next 90 to 180 days, on average, perhaps every 18 days, every 2.5 weeks, a good deal will come on the market. And now I can set myself up to buy, right? I build myself a flexible position where I don't have any timing pressure. Like I don't worry about my lease ending. Maybe I just stay at home, live with mom and dad if I'm graduating college for a few extra months to make sure that I am able to patiently find that property that I'm ready to buy instead of signing a lease for a year, for example. Or I go month to month in my first rental if that's not an option. And I put myself in a flexible position and I go fishing, right? Rather than reacting to the best deal that comes online on someone else's timeline, like my landlord's, right? So that would be the way I would frame the question of how to identify, and then set yourself up to make offers on a good deal in a practical sense.
Okay. And then the other part, like how much it would rent for, I'm assuming that information is also available to like, you can see what it is.
Absolutely. So I didn't, there's tools out there that help you estimate rent. So for example, our company has a rent estimation tool. There's another one called Rentometer. You can go on Craigslist or Zillow to look at what other properties of that type are renting for. And that should give you a range. You'll never be perfect on this, but you might know that, hey, that 2-bed, 1-bath property will rent for $1,400 to $1,700 in this area in Denver right now. And that way you say, okay, I know at the low end I'll get 1,400, but I might be able to get 16 or 1,700. If I if and if it works at 1,400, it definitely works at 16 or 1,700. I'm making even more profit. So that'd be one way to calculate rent. All part of that process of really getting to know your buy box and be very specific.
Okay, this is another one that, again, you could spend an entire talk on, but we'll try and do the Cliff Notes version of it. Sarah wants to know, how do you find good tenants? Because again, that's a big fear people have. Like, I have to be a landlord, I have to manage these tenants. I hear the horror stories of people trashing houses, not paying, being very hard to evict, et cetera, et cetera. How do I make sure I get the right one in the first time?
Love it. Okay, that's a fantastic question. And first of all, I want to outline that how do I get the right one in the first time? Many times, a property, when it's being sold with tenants, has an issue with the tenants, right? Why would somebody sell a perfectly fine property with no issues and great tenants in there? They're not. They're going to hold on to it. It's when the tenants become problems that they often sell the property. So what my first two properties actually were vacant when I purchased them, which is great. That allows me to place the tenant. It means I'm not going to get rent for a few months, but I also know that I can put my process in place. So the phrasing of that question was really intelligent from the student. So how do we get a good tenant? We need a process in place. We need to list an ad, all those kinds of things. And then we need to do a background, a credit, criminal, and background check, which includes calling references. So I have a form that I use and I have tenants fill out, and it lists things like prior addresses, their current employer. I want the contact information for the three most recent landlords that they had and to live with. And then I run a credit and criminal and background check. And I'm not really looking for like certain types of things. I'm looking for theft, right? If someone's stolen from other people in the past, that's a disqualifier for me. If they've been evicted and sued, that's a disqualifier for me, right? I'm not going to rent to somebody who got evicted. That's the ultimate failure from a tenant landlord relationship, right? And I never want to have to go through an eviction or keep it to as low a number as possible. And then the credit score is super important. If someone has a great credit, I've been at this company for 10 years now at Bigger Pockets. I have never come across any stories about a bad tenant where the tenant had a good credit score coming into the relationship. It doesn't mean that a tenant with a bad credit score can't be good. It's just that I've never come across someone that had a 700, 720 plus credit score and was a true disaster for a landlord. I'm sure that story will come out eventually. Maybe someone will know it on this call. But if there's a single number, a single criteria that you stick to with your guns, it's that credit score being above 650, 675 for a lower end unit, or 700, 720 for a higher end unit. And then last, call the references. When someone gives me their three prior landlords, I look at those references and I call them. But before I call them, I Google the landlord and see if I can't get their phone number from another source. Because sometimes the crafty tenant will give you the number of their buddy instead of their actual landlord. So when I'm able to do that and find the landlord information several different ways, ask those checks, I'm very, very confident that I've got a great tenant.
And just from the flip side of that, if we are going to be tenants ourselves in the near future, which many of you might be renters when you start off your kind of home life journey, making sure you have a good credit score and a good relationship with prior landlords is something that's going to be important to helping you find good deals in terms of landlords and places to live.
Yeah. I will say if someone was very young and just getting started in their career and had no credit score, that would be less of an issue. I'd probably ask a parent to co-sign the lease. In addition to that, or a friend to co-sign the lease, someone that had good credit, but I wouldn't disqualify a tenant for not having a credit score just because they were young. But you can so easily avoid that problem in the first place by just starting to build your credit now, getting a small credit card balance or using $50 a month or something like that to start building up some credit history.
Yeah, and we've talked about building credit in other videos, particularly one with Clifton Corbin, if you want to look up that. But credit cards, secure credit cards, your mini auto loans, personal loans, student loans, like those are different ways that you can demonstrate an ability to borrow money and pay it back. It doesn't mean that you go out and you try and spend extra money or sign up for debt just for the sake of it, but these are some ways that you could potentially demonstrate that you have a responsible history of paying money back. So look into that if you're looking to build your credit score now, or look for that video from Clifton. You'll probably see it linked at the end of this video, actually. All right. let's go into the final question. Scott, I ask this of every guest who comes on. What is your number one piece of advice for teens when it comes to building wealth?
Number one, I would say I'm going to cheat and give you two different ones. One is immerse yourself in the world of the self-education of this, right? It's great that you're doing money education, Rob, but at least when I was in high school, that was not a thing. And there's no like done. There's no, oh, you got an A, therefore it's a continuous process for life of managing wealth and understanding that the self-education you put in ties directly to the freedom and options you'll have in a few years. And the second one is almost like a little bit more disconnected from that. It's have a goal, have a position that you want to be in a few years from now that you can articulate and get behind. And my belief is that too many people push, what do you want to do when you grow up as the goal? How the heck are you going to know that? 10% of your friends, for those listening, are going to know what they want to do in 5 years with their profession. The rest of you are going to be like me and have no idea. And so the goal, in my opinion, if that's you, should be flexibility. I want the most flexible financial position possible with as much passive cash flow as possible so that I can do 10 different careers if I want to, or all these different things. But have a goal and then begin taking a step each quarter, each week if you can, or each day if you can, that slowly moves you towards that. And that compounding will get you to incredible places over time.
That's an awesome one. Goal setting is so important. And the fact that you said having short, medium, long-term goals, they should all feed into one another. So if you have this big goal in 5 years of wanting to own a duplex that is bringing enough cash to pay for it, what are the steps that you need to do in a couple of years' time? What's the step for next month? What's the step for right now that you can put into place to help get you towards that goal, and keep checking on yourself and making sure you're moving towards it? That's an awesome one. All right, Scott, I know everyone here should be following at Bigger Pockets. Make that a part of your newsfeed, because that's where you're going to find amazing information about real estate investing and just kind of personal finance in general. A lot of stuff comes up on that site. What else should people be doing in terms of who they follow, who they read, and where can they find you as well? Because I know you said education was so big, and I wanted to ask you, who do you recommend us listen to, learn from, read, watch, etc.?
Awesome. Yeah. There's an educator named Dan Sheeks. He wrote a book called First to a Million and has the Sheeks group. If if you want to go all out towards financial independence at an early age, that's a good resource. There's a blogger that I really like called Mr. Money Mustache, who's very hardcore about spending, that I would recommend checking out. Our friends over at Choose FI have another good kind of aggressive money approach. Dave Ramsey is a big name that a lot of people, if you want to go down the debt-free route and have a more kind of, a lower risk, but clearly, a high probability way to get to wealth. He's got a good approach as well. And then where the other question was, where can you find out more about Bigger Pockets?
And about you specifically.
Yeah, so I have an Instagram. It's at Scott_Trench. I host the Bigger Pockets Money podcast, which is one of 5 podcasts produced by the Bigger Pockets Network. And we talk about personal finance more so than real estate specifically. And I enjoy that. There's a lot of money stories. We have a couple of great stories from young people in their 20s who have, achieved financial freedom or built several $100,000 in net worth in a pretty rapid time. So those are fun. And Bigger Pockets just Googling that and going down to YouTube, podcast, social media, or whatever. We try to put out stuff on all those channels that are helpful and fun for real estate investors.
All right. So surround yourselves with people who are giving you great information. Learn from as many different sources, or at least your preferred sources. Like, there is so much information out there. Never stop learning. There is no like you are certified financially literate and you are done. As Scott said, like, there's always more to learn about. And the more you know, the less risk you're going to take, the more chance you're going to have of building that wealthy future that you really want. Scott, thank you so much for joining us today. Really appreciate your time. For those of you watching, thank you very much. Don't forget to hit subscribe on the YouTube channel if you're watching the replay, so you can see when I have more guests coming in to talk about different parts of personal finance that maybe you are not getting in your personal finance classrooms. But thank you for being here today, and we'll see you again soon.